Ladies and gentlemen, my name is Brad Matheny. Today is October 8th. We have Israel declaring war against Hamas. We have a credit debt crisis that's playing out. We have an incredible amount of U.S. spending that's taking place, as well as global central banks taking place. And we have a generally contracting economy, which I have been predicting for more than 2.5 years, related to a credit debt event that I believed was going to originate in China and Asia. Real simply, this video is designed to prepare you for what is coming. I've got a couple of screens set up. I've only got 20 minutes to go through and make a case to tell you what to expect. And I'm going to do so as efficiently as I can. So, number one, we're going to go back over here. I believe it is. Nope, here. And we are going to look at the oil is at the bottom. Fed funds rate is in the middle. Gold is up here in this gold color, and this is the S&P 500. So now, when's the last time that we had any major conflict? Was way back over here with 9/11. This is highlighting roughly 9/11. This was the dot-com bubble. I'll draw a vertical line here at the dot-com bubble, roughly end of 99. And what we had in this scenario, ladies and gentlemen, was a very broad double hammer type scenario. We had an excessive speculative phase that ended with broad war taking place after 9/11. Now, understand that 9/11, was obviously a horrible attack on the U.S., the first real attack in modern history on U.S. soil. But what took place afterwards was an extended war in Afghanistan and other areas. And what it did is it changed the way people expected the markets to react. Understand that while we had all of that war taking place and all of that uncertainty, it took nearly 14 months for the S&P, or sorry, 14 years for the S&P to rally outside of that range. So we stayed in this channel. We stayed very consolidated in this channel for almost 14 years before we finally got out of it. We are in a somewhat similar scenario. We have had a speculative rally coming up like this. We've seen our dead cat bounce here. We've seen our contraction phase. We've seen the economy contracting. We've seen yields shoot up. And we could very well be looking at an extended cycle phase trading within a range, which I believe will be between here and these 2018 lows here. I'm going to draw them roughly across here. We could be in a sideways range, trading and attempting to identify this wave 4 pullback. The wave 4 pullback currently originates here and comes to here. But because we don't have any new high price breakout, we could see this wave 4 pullback extend maybe 30-40% in the near future. And we could see the metals really begin to skyrocket after this really crazy pullback over the past couple of weeks. Now, oil is going to be a wild card. Two things are actually taking place with oil. Number one, the Fed is trying to curtail global credit expansion, and that in turn means that they're going to try to curtail excessive consumer consumption of credit. And that means that consumers are going to pull back on buying the expensive cars and buying the 4 miles a gallon trucks and everything that everybody was buying a year and a half, 2 years ago. And that means that oil is going to likely contract. Now, the Israel to Hamas war could extend out into Iran. We all know this. Could become a very desolate type of scenario where multiple nation states take sides. I can certainly see that this could lead to a push for a two-state nation in Israel, whereas the Palestinians have one state and Israel has another, possibly redrawing the borders. But my personal opinion is that's not going to hold up unless we have some coalition of not only Arab nations but Western nations acting in good faith to not only police and regulate the activities, so to say, of both parties while they learn to coincide with one another, but also to try to stabilize global markets, as this could turn into a real mess if everybody picks sides and draws lines in the sand. But what I wanted to highlight primarily was the Fed is trapped. Fear levels are accelerating. Gold has pulled back off of the last couple of weeks with the markets pulling back. I believe gold is setting up a washout bottom. I believe the Fed is trapped and is going to keep rates fairly high, at least for the next 12 to 15 months. So that means going into 2024 and through the elections, possibly into mid 2025. I see rates staying above basically 4%, 4.25%, no matter what the Fed decides to do or the world decides to do. The Fed must battle this inflationary trend, which is really excess capital working through the system. The excess capital, in fact, let me see if I can do this over here. Add US GDP. United States GDP. This looks like it'll work. And I'll close this, and this should be the new GDP number. Yep. So we'll change this to a green color. And what I want you to understand is that the capital that's working through the system, as the economy moves into what I believe is going to be a consolidated contraction phase. Remember, ladies and gentlemen, I believe that we are going to be staying within a moderate contraction phase throughout, and that includes this area here through basically early 2025. So I'm going to draw it right there. That's early 2025 right here. This is June, July, and I believe we could be looking at this type of a range, this type of a contraction, possibly a deeper pullback, which would be a wave 4, A, B, C move, possibly down into this area. And what I believe we're going to be looking at again is a deflationary cycle phase where certain stocks are going to do well, certain global markets are going to do well, but generally unwinding the excess credit phase. Okay. This is what's going to happen. Now, these are treasuries right here in the middle. These are 10-year treasuries, yield. And you can see that yield is skyrocketing. Okay. We've never seen this actually happen, although we did see something happen back over here before the dot-com bubble burst. So I want to highlight that. I will draw that as a rise in yields ahead of the dot-com bubble burst. We also have a massive rise in yields here. You can see it. I'm just dragging it there. We did not have a massive rise in yields during the global financial crisis. Ask yourself the question, why? Why did we not have a massive rise in yields, okay, during the global financial crisis? Is because the debt was centralized to, the crisis was centralized within the global banking system. It was seizing up, and the Fed acted very efficiently to relieve the pressure on the system with their TARP program and with other programs. Now we have a scenario where we've had COVID, we've had this hyperinflation, which is kind of like the dot-com bubble, and we've seen this unwinding phase, which, I would say is possibly like this sideways channel right over here. We don't have any real breakdown yet, and the breakdown took, quite a while. So we had this pullback here, which is kind of like COVID. We had this big bubble phase, rolled over, and then continued all the way down into this area. You can see that is basically from the COVID timeframe of 98 to the base bottom before we started to move was 2003. That's 4.5, 5.5 years. And we are only about a year into this, a year and a half into this. in my opinion, I think we need to be prepared for, an extended consolidation period where yields will rise to reflect proper crisis, debt level concerns. The U.S. Debt, federal debt, is going to continue to expand. I wanted to highlight here, after the 9/11 attacks, federal debt rose 51%. After the global financial crisis, federal debt rose 154%. That's from this area here up to this area here. That was the zero interest rate free for all that took place to rebuild the economy. Now we have this excessive bubble. This is going to deflate. The Fed is going to have to maintain liquidity throughout this entire time frame, which is global liquidity. We are likely to see the debt rise. We are likely to see GDP rise. Now understand that GDP here, let me shrink this down, is already at 25, almost $26 trillion. Our total debt is closing in on 32, almost $33 trillion. What's going to happen, in my opinion, is the Fed is going to facilitate a 4 to 5 year transition where we are going to establish a new operating norm with the credit event playing out. That's going to be 2025, 26, 27. They will keep the boat together. They will hold everything together. They will try to facilitate emergency credit funds to keep the entire global market system together. Where we run into problems is 2028, 29, 30, and beyond. And so understand that this means that we are likely going to see a wave 4 bottom somewhere over in here, maybe extending a bit downward, maybe coming back down into these lows. So we could see a bit of a repeat, kind of like this. But then we're going to end up in a wave 5 move somewhere around 2025. And the wave 5 expansion is going to be like this until maybe 2029, 2030. It's going to be very powerful to the upside. I mean, extremely powerful, huge, big expansion and trend. I'm drawing this just off what I believe is going to happen, but we'll take a look at this, and we're going to talk about from a potential low area to potential high area, your 280 to 300% rally in the SPY, moving from, call it 249 on the SPY, maybe 250 as a base, all the way up to probably 980, 990. A huge, huge rally. Now, during this time, commodities are going to be a big issue. Commodities like gold, silver, oil are going to be a big issue because we are going to be transitioning away from norms, which, for example, is lower yield bonds, moderate spending, moderate debt, moderate GDP growth. We're going to be moving into an excessive GDP growth, which is essential for money to move through the system properly. That's going to prompt global GDP to rise. It's going to prompt yields to rise until we move into some safe haven, which will be right over here. So understand that yields will start to contract when we move into this wave 5 mode. Okay, this is when we're going to start to see yields contract. This is when yields are actually going to realize that, okay, we've kind of weathered that storm. We're doing okay. In the meantime, we're going to be dealing with some concerns, which is why, if you understand what's happening in metals, we come back over here. When metals, remember, yields have been going down quite a bit. Now yields are rising. Metals are going to start to really move higher. They're going to really start to move higher, in my opinion. 3,500, 3,800 by the end of 2025 is not unlikely. Even 4,200 is not unlikely. Fed may drop interest rates 4.5, 4.25, but I don't believe they're going to go any deeper than that. And oil is likely already gone through the cycle to, as we saw here. So during the dot-com bubble, we had a little bit of a rise in oil, then we rolled downward during the contraction. During the global financial crisis, we had a massive spike in oil, which again rolled into a deep contraction. Post-COVID, we had the COVID shock, which was the supply side shock. Basically, the entire world shut down for 2 months. Then we saw the big rally in oil. Now I believe we're in the midst of a contraction that's going to put us back down into $50, $60 oil. But that's going to take 12, maybe 8 to 12 months. Okay. What's really happening is we're moving into an extended contraction phase, as I mentioned to you, staying kind of within this range, searching for a bottom, trying to set up a wave 5 bottom here, a wave 4 bottom here, or maybe a little deeper. Then we start the rally phase back to the upside. Gold should be well above 33, 3,400 by that time. Fed rates will probably be above, still be above 4. We have a very long-term setup here that I need you to be aware of. This is not short-term. I'm not telling you what's happening in the next 10 minutes. What I'm telling you is we're going to have increased volatility. The Fed will hold everything together. Gold and silver stackers will be able to really take advantage of this dip. So when we come back over here, here's my gold chart. We'll go to weekly. We are on weekly. Might be a little hard to see, but what I'm going to do is roll this out. I just got done doing the gold video, and I saw this setup, and I thought to myself, man, I got to tell everybody, as many people as I can. So here we have gold. This is the washout low. We're likely going to see it rally back up here to above 2,100, maybe 22, 2,300. But the long term here is that we are in a very solid rally phase, which is very similar to 2003 and 4 and 5. And I'm getting right back there right now. So you can see what's happening before I run out of time. So we are pretty much right in this area, right over here. This is what I call the setup phase. This is called the breakaway phase. This is called the expansion phase. I believe we're setting up in this area, and by 2020, call it 6, maybe 2027, as we start to understand the real risk to the system coming in 2028, 29, 30, we're going to be past this expansion phase. And that's where we see the huge rally take place in gold, which is going to be the real setup of the broad unwinding phase. Oh, I already have one here. That is a 160% rally in gold. So by my estimate, before I run out of time, where I'm at right now in gold, and if we were to see that 160% rally from the expansion phase, we would be looking at gold moving into 160% roughly from here. Really got to drag it down, don't I? 160%, hopefully before I run out of time, would put gold at about 10,000. And that's going to be the 2029, 30, 31 possible target for gold. Okay. And it all depends again on what happens back over here. Are we going to see the setup phase, the breakaway phase, and the expansion phase, which are all right here? There's the setup, the breakaway phase, the expansion phase, play out like I expect. Again, this is the next 3 years. Gold is going to move from 1820 to over 4,000 over the next 3 years. 140% increase. But it's dependent on the move that I'm talking about here to take place. We need to see a wave 4 bottom setup. We need to see a wave 5 expansion. We need the Fed to hold everything together. And we need to see treasuries peak, roll downward, and the Fed to really hold it together. If the war turns into a big problem, everything could be kaput, and we could see a large downward trend taking place. So again, pay attention, guys. This is a huge opportunity. No matter what happens, if you're following my research and you follow my systems, this is a huge opportunity for profits and gains. You just got to stay ahead of these big trends and really understand the macro side of the market. That's it for now.